Welcome everybody to Mirae Asset's inaugural ESG Summit. Thank you all for taking the time to join us today. For those of you that have not met me previously, my name is Nicolas Jones. I'm based in Mirae Asset's London office. For today's webinar, we have a comprehensive agenda lined up for you. We have a number of internal and external speakers participating in today's event, and I hope you find the summit both enjoyable as well as educational. We've separated today's events into two sessions, so I do hope you can join us for the complete programme here today. We've also set aside time for questions and answers, so for those of you joining us live today, please do feel to send through questions at the end of each session. If anybody does prefer, then please also send through questions via email to your local Mirae sales representative, and we will come back to you post the event. I'd now like to open the summit by introducing Mr. Jung Rhee. Mr. Rhee is the CEO of Mirae Asset Global Investments, Hong Kong. Mr. Rhee, welcome.
Thank you, Nick. Hello, everyone. Thank you so much for your participating in this conference. I'm very happy to have all in talking about the ESG investing in Asia. ESG investing in Asia is very rapidly surging, but also very challenging topics due to a lot of economic and cultural nuance differences. As a Asia homegrown asset manager leading the ESG investing in this region, I'd like to share the experience of our investment team involving ESG investing in Asia. As the first Asia homegrown asset manager to launch the first UCITS Article 8 compliant fund, and also the first Asia Hong Kong-based asset manager to sign off the UNPRI since 2015. I'm happy to share all the challenges and experience we have been embracing during the last several years. Rahul and the investment team can share all the details from this session. Thank you so much.
For the first session, we will be reviewing the ESG regulatory developments. The key areas that we will be looking to discuss are the introduction to the regional and global ESG landscape, what are some of the up-and-coming ESG regulations to watch out for, and what are the potential implications to investors. In order to discuss the topic today, I'm pleased to be joined by Kasia Zatorska. Kasia is a senior manager within Ogier's global sustainable investment consultant team. Prior to joining Ogier, Kasia led the Institutional Shareholder Services Hong Kong office. Kasia has also previously worked at Legal & General Investment Management in London, where she gained first-hand experience on how to design and implement ESG thematic frameworks. Kasia, if I could ask you to commence your presentation, please.
Thank you, Nicolas. Pleasure to be here. Thank you for your kind invitation. Quite topical, actually, that just as the COP26 has come to an end, I think we all have seen quite a number of reviews on this conference. I think it's a bit of a mixed bag on sort of positive and negatives. I think the overall feeling is that it was a glass half empty in terms of certain commitments made, particularly within finance. And I think this is why we believe that it is going to be, the next couple of years will be very important in terms of regulation and also in terms of how the whole finance will move and how quickly will it move towards further integration of the ESG strategies. If I may, Ogier Global, we are a growing part of the ESG ecosystem where we provide consulting technical expertise to fund managers and asset owners with relation to growing regulation, not only in Asia, but also globally. And where we see that at the moment, the most important limelight on regulation, as you can see on the slide, is mainly coming from climate risk. This is mainly because the TCFD has shined the light on how climate risk can be perhaps a causality to some of the risks stemming from stranded assets, physical risk, and also then transition risk, and which is why this has become a key topic from the regulators to link it to disclosure, but also link it to development of ESG policy globally, also development of risk, or update, I should say, of risk management processes and investment strategies. The overarching regulation that has been, I'm sure everybody's been watching, is the EU Sustainable Finance Disclosure Regulation. The reason why this particular regulation has been of vital importance is because not only those funds who exist in market in the EU, but those outside of EU that also trying to market into the EU will be or are regulated by this regulation. Now, there are parts of it that we are still trying to work out. The first disclosure requirements were introduced in March this year. So the market is still trying to, I would say, figure out what is the best way to interpret the European Union's regulation and the wording. There is still parts of the regulation, level 2 RTS, that has been delayed and now will be due to come out in June 2022. So we're waiting with that in anticipation because there's still part of the puzzle that we are not fully understanding. And yet the market has already been asked to position themselves against this regulation. And as Mr. Rhee has pointed, Mirae has been one of the first ones to have an Article 8 regulation. There's a recent study by Morningstar has shown that a very large majority, over 70% of the market, has categorized themselves as Article 6, which is the fund that does not have any particular environmental or social characteristics. The 20% is Article 8, and then the remaining 10% is only Article 9. Now, I think this categorization of funds have somewhat become, this was probably unintentional. I don't think the European Union actually has tried to sway the market either way. I think what has happened, and we see it with our clients at the moment, is that because the disclosures were, it felt like it were quite burdensome for the Article 8 or 9. I think a lot of the funds have decided that for now they will just be disclosing as if it's Article 6. And probably what we expect in Ogier is that as the market learns more about the regulation in the coming months, successively a big share of those Article 6 funds will start to disclose also as Article 8. So as you can see here, the two articles are actually based on two levels. So it's on the entity level and product level. The entity level regulations are already quite well established. There's a number of companies disclosures that have been known. The product level disclosures are still in the making, so to speak, with the, as I mentioned, with the RTS level 2 regulation. So there's a lot of the second part of the puzzle is still what the market is trying to work out. And on top of it, there's also the EU taxonomy that also will then impose certain requirements for those funds from Article 8 and from Article 9. But again, the language here is not fully known and is only been at the moment interpreted by lawyers and industry experts. But the full disclosure requirements we will have to wait for until next year. So this is where I started to mention how Article 6 products and 8 and 9 categorized within the gray and then the light green and the darker green products. Again, I guess the European Union and the bigger picture of SFDR and how this is going to have an impact on global or Asian regulation is that We've seen a lot of regulation at the moment in Asia. In December, Monetary Authority of Singapore. In August this year, the SFC of Hong Kong. Prior to that, there was also a banking regulation in Malaysia. A lot of these regulations are taking framework of TCFD as the overarching 4 pillars. So there's governance, risk, investment, and disclosures. And all of them are alluding to the fact that fund managers will have to think about risk, climate risk, physical and transition risk in those categories. SFDR is moving away from that a little bit, sort of trying to go deeper, naming 14 metrics that are mandatory and 18 that are optional. So a little bit deeper level of analysis will be required from the fund managers. But similarly, we believe that as the regulation progresses in Asia and as the regulators in Asia start to go towards more common sort of pan-Asian or pan-global regulation towards climate change, we actually believe that the SFDR framework will be the one that is the overarching framework rather than the TCFD. So this is the regulation that I've mentioned. So it's Hong Kong. There also has been regulation happening in mainland, although that's still not fully yet clarified with regards to the asset managers. The one we now watching Ogier as well is the UK, because that's still at the consultation level. And the US regulation, where we believe that there will also be a strong recommendation at the moment towards TCFD frameworks, perhaps with disclosures being mandatory rather than just comply and explain mode. This slide is how this is actually taken from about the finance committed at the COP26, is trying to set a scene of how the disclosures that various the fund management is required to take on, how this disclosure can be also transition into an opportunities. So $125 trillion is required to finance the energy transitions towards net zero. And in that pool of money, in that pool of funds, there's quite a number of opportunities and sectors that need that financing faster than others. So the table on the right is about which sectors will need the funding the most and the quickest, and which sectors will probably be able to wait until 2050. As you can see, there's and also it came out quite clearly from COP26, where there's overarching 5 sectors that we will have to focus our decarbonization paths very quickly, and where the majority of the finance have to be probably, or will try to be, a funnel into, as well as a number of other sectors that will be transitioning, but like I said, it's probably at the slower pace. This is the Glasgow Financial Alliance for Net Zero. Like I mentioned, it was the major achievement of the COP25 in finance this year is that the Glasgow Financial Alliance has set up a framework, and probably that's the major positive thing that has come out from COP for us, is that it is unified the framework, so the number of key indicators that both companies will have to look at and disclose, and at the same time is the same number of metrics then asset managers will be able to assess in their investment strategies. So this is a very important step, because at the moment, I believe we have something close to 35 different frameworks of disclosure. So the regulatory and disclosure burden on these companies have been quite significant. So we're hoping that by streamlining the disclosure regulation, this will also allow for further quite rapid increase of transparency, which will then allow fund management and finance to, again, position themselves and seek those opportunities in a more clear way. So what are the implications to investors, as Nicolas have said? As you can see from this two graphs that I've put here, it's the number of ESG strategies have really been on record high in 2020. And this is partially driven because of demand from the new funds and the demand new finance seeking opportunities, but it's also been driven because of the regulation and changes in the regulation that has reclassified some of these funds. So also probably as well because the ESG in 2020 was performing very strongly against other strategies, which has creating a further momentum to creation of these strategies. And as you can see, climate really is number one strategy at the moment. Although certain other aspects like social and biodiversity will probably also follow suit in the next couple of years. Now, this is an interesting slide. There was a survey recently done by Willis Towers Watson based on more than 60 asset owners in Asia, which looked into the how much availability of ESG strategies there are, but also try to examine how many of these asset owners already have ESG implemented in strategies. And it wasn't actually a surprise to me that only about 30% of asset owners mentioned in that survey have indicated that they have some kind of ESG policy in place, although some of them question the robustness of this policy, and only further 10% express that they will be setting an ESG policy in the next 12 months. So as you can see, the share of the demand from asset owners is still relatively small for the ESG strategies. And I think this is where the more conversation, more education has to come to that particular group of managers in order for the asset management world then to respond to that demand. So other highlights of the survey is that the asset owners felt that in fact some of the strategies that they would like to be implementing on the ESG front haven't actually been suitable for them, and this is why they would like to see the demand of the ESG strategies to be, I would say maybe not demand, but the wider pool of different strategies available to them, so they can choose from, in order for their assets under management to be fully invested within the ESG strategies. Oh, thank you. So the point I'm trying to make is that at the moment we are very much at the point of inflection, the regulation, both on the regulation side, on the demand side, but as well the SFDR will force the regulation globally to make the asset management will think and position themselves not only in Europe but also in Asia, and hopefully that will also see very quickly the demand within the asset managers here. Thank you.
Kasia, thank you very much for the presentation. We would like to invite you back for questions after our next session, so thank you very much for that. So I'd now like to introduce our next speaker, Tim Chan. Tim is an ESG strategist at Morgan Stanley. Tim joined Morgan Stanley in 2020 and is a member of the Global Sustainability Research Team, leading Morgan Stanley's ESG research in Asia Pacific. Morgan Stanley's institutional research team are ranked #1 in the Institutional Investor All Asia Research Poll in 2021. Prior to joining Morgan Stanley, Tim was a senior ESG analyst at Manulife Investment Management, where he held an ESG integration research and engagement efforts in North Asia. Over the course of the next 20 minutes, Tim will discuss the ESG investment market and trends. The key points that Tim will discuss during his presentation are an overview of ESG investing trends in Asia, how are the investors approaching ESG, and what are the key ESG themes or ESG investment strategies investors are incorporating into their portfolios. Tim, if I could ask you to commence your presentation, please. Thank you.
Sure. Thank you so much, Nick, and thank you for the introduction. My name is Tim Chan. And as Nick mentioned, I'm the equity strategist in Morgan Stanley, covering ESG research for Asia Pacific. And in today's sessions, I'm going to talk about how we're going to conduct research in Morgan Stanley and some of the key themes that we think are important for investors going into 2022. So first of all, this is our global team. And as you can see, we are a global team of 8 people covering different aspects of ESG. Victoria and Mark and myself cover ESG in different regions. And we have Caroline Campbell, who is our analyst on fixed income in ESG. And then our global head of ESG, Jessica Osford. She is based in London, but she runs the team globally. And also she is responsible for global thematic ESG research. So if you are an institutional investor, then you can actually get access to our research portal, which is called Morgan Stanley Matters, and you can just type ESG Matters to see all our reports in the Morgan Stanley research portal. So just a big background about how we conduct ESG research. So we have 3 different pillars to our research. First of all, is systematic. We advise investors globally on how they implement ESG strategy, whether it is for mainstream funds or for sustainability funds. And then we also do some back testing to see whether there are any correlation between ESG performance, ESG scores, and stock performance. And the result generally is not very conclusive. And the second pillar is integration. We work with our strategists, economists, sector analysts to identify what are the key drivers of ESG in their valuation process. And the way that we do it is that we categorize ESG factors into explicit ESG value drivers and implicit ESG value drivers. And I'm going to talk about these drivers in a minute. And the third and final pillar is thematic. We also do deep dive ESG research reports on different themes. And in Asia, we have done some thematic research on China climate change, which is a huge topic. And then we have also done something about China governance and also Japan investor engagement and activism. So going more deeply into our ESG integration process, this year we have launched a new ESG tool called ESG Risk Reward. And as you can see from the chart here, we have listed out what are the key ESG data and metrics related to each stock under Morgan Stanley coverage. And we also provide whether the company is improving or deteriorating in ESG performance, because we think the direction of travel is more important than the absolute performance right now. So we provide a proprietary ESG indicator of change, which you can also find from our research portal for the stock under Morgan Stanley coverage. And I mentioned ESG integration, that is also a key part of our research. And as you can see from this slide, we listed out what are the key ESG areas for each sector in our sector coverage. And then each sector will have different E and S and G focus, and we categorize these focus or factors into explicit and implicit factors. And it might be easier for me to explain chemical sectors as an example. So explicit factors are value drivers that can be independently analyzed, and they can also be linked to companies' financials directly. For example, chemicals sectors, we identify the percentage growth from renewable energy is one of the explicit factors under climate change, because we think analysts can easily integrate these factors into the valuation process. And for implicit factors, these factors are also material ESG factors, but the linkage to valuation may be less direct. For example, employee turnover and engagement under human capital, we can quantify how much turnover rate is disclosed by a company, but the linkage between turnover and valuation is not quite direct in the valuation process. And for the governance factors, we think these are quite common, and then we identify several factors under corporate governance and ethics and culture for our analysts to integrate in their valuation process. And that is a brief background about how we integrate ESG research and how we run our Asia Pacific ESG research. And then in the last session, I'm going to talk about the 3 key themes that we think are important going into 2022. So the first key theme is on the fund flow. So Kasia has also mentioned we are seeing a very strong momentum of ESG fund flow and fund launch in APAC. And then just to give you some figures about the fund flow in APAC, especially in the third quarter, we are seeing around 11 billion of US dollars going into ESG strategies. And then APAC is still accounting for just 8% of global ESG fund flow as of now, even though the percentage of shares from APAC has been increasing. And then in terms of AUM, we expect the APAC ESG AUM could increase by 4 times to around 500 billion by 2025. The reason why we believe there should be such a significant level of increase is that compared with other regions like Europe and US, APAC is still having a lower penetration rate of ESG strategies. And currently, the ESG penetration rate is just 2%. So if we also look at Europe as an example, Europe, we are having a penetration rate of 15%. So that indicates a very long runway of growth for Asia ESG strategies. And then in terms of fund launches, we are seeing a similar strong momentum as well. And then as you can see, the 2021 year-to-date fund launch is already bigger than the total fund launch last year. So we think the question is no longer the momentum, but it will become how do we assess the authenticities of ESG funds, whether there is any greenwashing or not. So Kasia mentioned regulation play a very important role of identifying greenwashing, and we do believe regulators and regulations will have a strong role, especially in Hong Kong and in India. There are already regulations that help investors to ask the right questions, and also to require investors to enhance their disclosure on how their ESG funds are managed. And then globally, we have also seen IOSCO have published some recommendations to policymakers so that asset managers can enhance their disclosure as well, relating to how they run their ESG funds. So this is just a table showing the MSCI ESG indices versus the conventional regional indices. And then in APAC, you can see on a 5-year basis, ESG strategies have outperformed the conventional index by 5 basis points. So talking about the themes that we think are important going into last year, we think one of the themes is on climate change. And then climate change actually dominated our discussion with investors during the past 2 or 3 years. In 2020, we have seen Japan, China, Korea have all announced net zero targets. And then last year, we have seen many countries have released more details about their net zero plans. And actually going into this year, we think there may not be a lot of new catalysts on climate change. And this should be a year of implementations rather than seeing new policy information and targets. And especially if we look at the charts right now in the slide, you can see the climate change stock have performed strongly compared to the MSCI APAC index. And that's why we are more cautious about the direct climate change play, including renewable energies, EV, energy storage, and energy efficiency. And that's why we think investors should turn their focus on alternative green themes and also social themes, and that includes circular economy, biodiversity, and water, because these themes are equally important as climate change, and they are also getting a lot of regulator support. So just take an example in circular economy. In the carbon peaking plan announced by the Chinese government, there is actually a granular target about how Chinese government should achieve recycling of different materials. And then in ASEAN region, we also see circular economy is a big theme in the environmental space. So on the social part as well, we are seeing a huge China regulatory reform as well during the past 6 months. And then if you look at the details of these regulatory reform, many of them have focused on social themes, especially we think they might benefit social themes such as commercial insurance, and then many of the mass consumption brands as well. So this is just a table comparing the climate commitment by the major markets. So we mentioned we may not see a lot of new catalysts on climate change, but an exception can be made for India, because India made a surprise announcement during COP26 on its net zero target, and the country has committed to reach net zero target by 2070. So we expect to see more details of the implementations of India's decarbonization in different areas, including emission reductions, power generation, energy efficiencies, and others. So the second theme that we think is important is on physical risk. So if you look at the announcement during COP26, and after all this announcement, there are actually different research bodies, and they have published research on the trajectory of global warming after all these pledges and targets. And IEA and Climate Action Tracker have also published their research showing that it is not very likely for us to hold the global warming to 1.5 degrees Celsius. So that's why we think rather than just looking at the transition risk of climate change, we think physical risk should become the less focus. And that is actually more important for Asia as well, because we think Asia and emerging market is more vulnerable to physical risk. So this table shows how different parts of the world are exposed to different physical risks, and that includes flooding, tsunami, etc. And then if you look at the table, higher score actually means high risk, and then the EM is having a higher score than the DM as a whole. And within the emerging markets, you can see that Asia emerging markets is also having a higher score. That means they are more exposed to physical risk. So within APAC, China, India, Philippines are the three countries that are most exposed to physical hazards such as flooding, tsunami, and others. So we think investors should definitely watch out for the implications of these physical risks, especially on higher infrastructure spending and probably more need for commercial insurance. So the third theme about ESG in Asia that we think is important is on engagement. So we have heard about the engagement trend from many investors in Asia and globally as well. And then we definitely think the ESG engagement trend will continue going into this year. But if we just focus on the alpha generation opportunities, we think investors can probably find more alpha opportunities in Japan. The reason why is because Japan is a market that has traditionally attracted a lot of activist investors. And then if you look at the Japanese companies as a whole, many companies have a high cash balance. They have a very extensive cost shareholding pattern. And then in Japan, we can also find an increase in AUM of engagement funds. So many of these engagements have been focusing on governance especially on the independence, cost shareholdings, and also the parent and child relationship between the conglomerates and the investment holdings. And then if we also look at the investors that focus on engagement theme, especially on governance, many of them has been generating alpha from engaging with these Japanese companies, and they have an annualized return of around 13% by holding these companies for around 22 months. So we think governance engagement in Japan could be an alpha generation source. But the environmental theme and social themes are also getting more and more important and engagement as well. And we are also hearing lots of corporates and investors are having discussions in the boardroom on climate change. And just take Japan as an example, you can see the environmental shareholder solutions accounted for 15% of the total shareholder proposals in Japan last year. And this is my last line, and then I would just like to share our views on the energy sector as well. Because if you look at the recent stock performance of the energy sector, many of them has been performing quite well. And one of the reasons we think is because of the high energy price. And we have got many questions from investors asking whether there are any ESG concerns or ESG risk by investing in these ESG sectors or ESG companies, by investing in these energy companies. So we think there are some uncertainty surrounding the energy sectors as well, especially if you look at the CO2 emissions and also the renewable energy mix of these countries, including the EMEA countries, which is very energy intensive. So they are having a higher carbon emissions per capita and also having a lower renewable energy mix if you compare with the Asia Pacific average. So they may face a higher transition cost in future because they may have to invest in lots more resources to meet their net zero target. And then if we also look at the companies within these regions, many of them are facing exclusion pressures from investors and also from the banks as well. So we do think there are also some long-term uncertainty surrounding the energy sector, even though the performance has been strong in recent months. So with that, I would like to just wrap up my presentation, and then thank you for everyone for listening. I would like to hand it back to Lake for Q&A.
Tim, thank you very much for the presentation. We would now like to open up for questions for Tim and for Kasia. For those of you joining live today, there is an option to send through questions directly to the panel. We've had some questions already come through, so maybe I could just direct those questions initially to Kasia. Kasia, we've had a couple of questions. If you can just bear with me while I try and sort of get through them for you. The first question is in relation to the similarities between ESG regulations across the different jurisdictions. And the follow-on question to that is, which jurisdictions are more advanced and which jurisdictions are slower to adapt to incorporating new regulations? And there's a second part, or another question that came through, which is linked. Is the EU more advanced than the US with the adoption of ESG regulations?
All very good questions, thank you. Similarities, as I mentioned in my presentation, is mainly the TCFD. So there are 4 pillars, and TCFD has recognized them as circles, which sort of one is interconnected to another. So there's metrics, and then risk, and then management, and then also strategy, and then disclosure, right, on governance. So these are all interconnected because if you think about how you're designing a strategy, it comes from a portfolio manager, but there's also an element of a risk management within the company. There's also an element of a big role of senior management and also governance and board of directors that play a huge role, which is why, for example, the recent regulation from SFC and MAS in Singapore put a heavy weight on the fact that boards of directors have to be at least climate aware, if not fully climate trained at this stage, so that the drive to change, to to be able to understand the kind of brilliant research that Tim has just presented to us, they are able to understand where this how this can translate into returns, and also, what is a physical risk, and how the factors that they can read about, how does it really translate into the investment on the companies that they're doing, right? So the TCFD for sure will be the overarching theme for the next, I would say, 3 to 5 years. And I think until markets get their head around the SFDR, I wouldn't say SFDR is necessarily more sophisticated, and I don't want to be using words that it's burden, it's a regulatory burden, but I guess because we don't know all the pieces of the puzzle, and also we don't know how the market will interpret them, right? At the moment, it looks like there's quite a few annexes to be filled in. There's quite a number of indicators that they need to be looking at. There is a certain part of disclosures that need to be done in very particular way. So I can understand how some of the fund managers, frankly, they're probably getting frustrated with it and have no desire to be, as a result of Article 8 or Article 9. But I think once we get used to it and we get our heads around it, probably SFDR is the one that will prevent more greenwashing, will prevent statements that something is just a nice marketing strategy, and it will start to really show metrics over time how the strategies are there to mitigate climate change, to adapt for physical and transition risk, how social factors are being really incorporated into those strategies, right? So there's a number of factors. And then lastly, your question about the question from the audience about the US and EU. I think at the moment, the regulators in the US have not yet fully revealed what is it that they're thinking. There was a very wide consultation period. I think they're thinking about, what is the next step, whether they should go step by step, a little bit like in Asia, where initially it's going to be climate change and then next steps will follow. So we cannot yet tell at this stage whether this will be a very big step forward towards climate change, or is it just going to be little by little regulation that will trickle down over the years?
Kasia, thank you for that. Tim, we've had a couple of questions come through, which again, I will link the questions because they slightly overlap, if I may. And the question is, what are the barriers for ESG investing? Is it still the lack of transparency and quality of ESG disclosures? And following on to that question, are there any particular barriers that are specific to ESG investing for Asian equities?
Yep, that's a great question, Nick. So I think data is definitely one of the challenge in Asia Pacific. And then if you look at the ESG disclosure from companies, many of them are very compliance oriented, I would say. So they have usually published their ESG reports using using the guidelines from the regulators. But we have also looked into the disclosure of ESG in Asia Pacific. We have found that not many companies are using international guidelines like GRI, TCFD, especially TCFD. This is a guideline that is more oriented to investors. So we think many companies are still having a very compliance mindset when they disclose or discuss ESG matters in their operations. So one of the examples is that many companies are still reporting their ESG data using a lot of case studies, which may not be very material to their overall operation or ESG risk. And then not many of them have provided forward-looking information on ESG as well, which is, I would argue, that is more valuable to investors. So I would say that is a challenge in Asia Pacific in particular, because when you compare APAC and Europe, APAC is still a very nascent market for ESG development.
Tim, thank you for that. We've just got time for one further question that's come through, and I guess it's relevant actually for both of you. So if I can just ask the question initially. The UN Climate Change Conference, COP26, has just finished. What are your views on the key takeaways of the conference, and were they in line with your individual expectations? If I could maybe ask Kasia to comment first.
Sure. Like I mentioned, I think it's a mixed bag. I think for me, it was a little bit of a glass half empty. I understand that there has been some milestones, agreements that we haven't seen. And I understand that there's a number of countries that improved on the NDCs, which was actually quite significant. I believe it was 80% of countries that updated their NDCs, but there is still quite a lot remaining to be worked out. And I think, realistically speaking, if we have some targets to be achieved by 2030, that it's literally 9 years away, it's 8 years away, in fact. So unless we start to really accelerate on certain commitments towards the end of this decade, I don't see how we can meet those targets, to be honest.
Yeah, just to echo what Kasia mentioned, I think the outcome of COP26 has been quite in line with our expectation. With the major emitters like China and US, they have only formalized their existing targets without announcing new targets. And I think the only surprise is on India, which has announced a new net zero target. And then I also think one of the biggest key takeaway for me is that there are also a huge momentum of support from the private sectors on decarbonization technologies. And we think that is also important because when we look at the decarbonization theme as an investment theme, we think the enabler of decarbonization, such as technology providers, EV, renewables, these are the drivers of the stock performance under decarbonization theme. So if we can get more support from the private sector on developing these decarbonization technologies, then eventually the cost of these technologies will come down, and these may benefit decarbonization enablers in Asia Pacific and also globally as a whole. So we think that may also impact the investment thesis on how we look at the decarbonization theme in Asia Pacific.
Tim, thank you for that. Well, that actually now does conclude the first part of today's summit. I'd like to straight away thank both Tim and Kasia for their excellent presentations and their happiness to take questions from the audience. So thank you both for joining. Thank you for your participation. And if anybody who's joined today has any additional questions, as I mentioned, please do send them through electronically to your local Mirae salesperson, and we'll come back to you with a written response post the event. The second session will commence momentarily, so please do return to the homepage. Welcome everybody to the second part of our ESG Summit today. During this second session, our panel will discuss corporate actions on ESG. The key points that the panel will discuss are what are the key drivers and barriers for ESG in Asia, which ESG issues are material and how are they tackling those issues, and what are the challenges companies face, particularly for those in sectors that are emission intensive amid a transition to a low carbon future. Today's panel will be moderated by Rahul Chadha. Rahul is the Chief Investment Officer at Mirae Asset Global Investments Hong Kong and oversees the entire investment unit. Rahul is a member of the investment committee and plays a key role in developing internal investment policies, processes and key investment decisions on behalf of the firm. Rahul manages a number of the Asia Pacific equity portfolios and frequently interacts with portfolio companies and investors to communicate Mirae Asset's investment policy and views on Asian markets. Joining Rahul on the panel today is Satish Pai. Satish is a managing director of Hindalco Industries. Satish took over as the CEO of Hindalco's aluminium business in August 2013. Satish was the driving force behind 3 mega greenfield projects that established Hindalco as one of the biggest producers of primary aluminium in Asia. Satish is also on the board of Hindalco's subsidiary Novelis. This is the world's largest aluminium rolling and recycling company. Joining Satish and Rahul on the panel is Rajiv Bansal. Rajiv is a Senior Executive Director at Dalmia Bharat Limited, leading the company's Strategy and Transformation Department. As part of the senior leadership team, Rajiv is responsible for strengthening existing mandates, as well as formulating new initiatives that align with the company's long-term goals and visions. Rajiv has over 26 years of experience across multiple industries, including power, generation, telecom, IT services, and internet startups. Before I hand over to Rahul, I'd also like to remind everybody joining us today that you can send through questions via the automated facility for the panelists to answer. Rahul, if I could ask you to commence the panel discussion. Thank you.
Thanks, Nick, for the wonderful introduction. Thanks, Mr. Pai, for agreeing to join us. Thanks, Rajiv, for being a part of this session where both of you have agreed to share your wonderful story, the journey of ESG over the years, and the immense value it's created. When we set out talking about this ESG Summit, me and Holly were discussing, and the idea was to share the experiences. The thought was, should we call somebody from a low carbon footprint industry, something like a fintech, something like an internet platform? And the answer was no. I mean, we've got to have companies which are much needed for building the economy, which are kind of the building blocks of this real world, and them come and share how they are growing, how they are giving us the much needed resources while reducing their carbon footprint. So that's where we have both of you, Mr. Pai and Rajiv, joining us. Would be nice, Mr. Pai, to start with you. Again, it's truly commendable, the whole recycling Novelis has achieved. It's truly commendable that, again, Hindalco is really the most sustainable company in the aluminum sector in the Dow Jones Sustainable Index. So it would be nice to hear your part of the story, this whole journey of how you managed to achieve this over the last 7 years at Hindalco.
Yeah, thank you, Rahul. So let me give you a little bit of a broad perspective of how Hindalco and Novelis have looked at the whole ESG story. So I think that the first important thing for us is that when people talk about ESG, you will notice very quickly that very often the discussion straight away goes to the carbon footprint. And in many ways, that is very important from a climate change point of view. But the discussion, unfortunately, sometimes just gets caught on that one point, and they forget that ESG stands for other environmental issues, social issues, and governance issues. It's actually ESG. So I think the one point I wanted to make is that for us, and when we have communicated to investors, to employees, a very broad ESG strategy that covers in a very holistic way not just the carbon emissions, but the waste, the circular economy, and hence the recycling, the biodiversity issue, as well as water. And I think that water in this part of the world is actually as important. So we have a very comprehensive E, and then of course on the social side, Hindalco actually in India has got a very long-standing, over the last 60 years, a very deep-rooted commitment to the community's livelihood generation efforts that we have ongoing. And of course, last but not the least, the governance part, which I think we are quite well known for. So we have put together a comprehensive ESG platform. And I'll tell you, as you said, right off the bat, that the weakest part of the story for Hindalco is our energy source in India, which is coal. So there's no hiding from that point, and we can discuss what we're going to do about that. But knowing the weak point of Hindalco, we have actually concentrated on making all the other parts of ESG probably world-beating or world number one in our industry sector. So that's why when you take the overall Dow Jones Sustainability Report that just came out, we are ranked above Alcoa and Norsk Hydro in the aluminium sector. So I think the point about ESG that you rightfully made at the beginning is that this is going to be a tough, hard slog for companies like us, which have a power source that is going to take some time to transition into a low carbon energy source. But we have to recognize at the same time that the metal that we produce, which is mostly aluminum and copper, these are metals that are playing a big role in the transformation of the world from a green economy point of view. So whether you talk about electric vehicles, whether you talk about electrification, most of these things use a huge amount of aluminum and copper. So I think that the world needs more aluminum and copper if it is going to become more sustainable and it's going to become more green. So I think companies like us have the challenge of producing the products that we make, but at the same time making sure that we can meet the carbon commitments that we have and all the other ESG. So that's what we have tried to do. And I'm happy that for the second year in running, we have been ranked as the #1 sustainable company in the aluminium sector.
I think those are those are wonderful comments, Mr. Pai. Rajiv, coming to you again. When you joined Dalmia, as you jokingly say, I was one of the first external investors you kind of chatted with. So your journey from Infosys, from DXX Technologies, and now at Dalmia, and again, particularly focusing more importantly on the governance front, and then we'll talk about obviously carbon footprint, etc.
Yeah, Rahul, I remember, you were the first one I spoke to after joining the company when I was talking to investors. And I think you gave me kind of a starting point of where to start my journey at Dalmia Bharat. It's a very interesting to come back and join an old economy company. As Mr. Pai jokingly tells me, Rajiv, you've gone back 3 generations. The current generation is internet, the previous generation was IT, and the old economy is the 3rd generation. You've gone back 3 generations. And, the journey has been nothing but amazing. I think I've completed about a year here. And what I see is a huge opportunity for a sector like cement in a country like India, right? This century belongs to India. If you look at the Indian economy, you look at a lot of things which are going right for us as a country. And to really be able to capture the opportunity that we have, infrastructure will play a very, very big role, right? And we have a pragmatic government, we have a start of a capex cycle, infrastructure cycle. There's a liquidity-driven economy, interest rates are low, and I think we are at the start of something big. And so it's very exciting to be a part of a sector and a company which has huge potential. And we at Dalmia Bharat, I think we have done exceedingly well over the last 10, 20 years. We are almost about 33 million ton capacity. We have about 6 months back articulated our capex plans. We want to be a 130 million ton company in the next 10 years. We have a very clear capital allocation policy. So I think we have started putting the building blocks for doing something big and doing something great. So I think very excited to be part of this company, this journey. I think, yes, I started with governance. I think governance was one of the most important things that I started out with. And we have done a lot of stuff to be able to gain back the confidence of the investors and all the stakeholders from that perspective. And now as a part of the transformation journey, we're also driving the finance transformation, the HR transformation, the ESG journey, the whole branding and the communication and everything. So there's a whole lot of stuff to be done. Especially on the environment side also, if I can just cover that part too, as you rightly said, why call a fintech which are kind of carbon neutral or carbon negative, and, look at some of the biggest polluters in this world and call them and ask them, what are you going to do and how are you going to do things differently? I think it's probably the best way of doing it. And, cement just produce 8% of the global carbon emissions. And there's no denying the fact that, after steel, we are the biggest polluters in this world. But if you just break up the whole thing or problem into 2 different parts, one is, cement is also the cheapest commodity available in the world. It is the most widely man-made resource used in the world, right? A cement is available at 6 rupees per kg. Even a 1 kg of salt or a 1 liter of bottle of distillery water costs much more. So cement is the cheapest commodity available, and it is one of the most important man-made material which is required for nation building, infrastructure building. So there's no denying the fact that cement is here to stay. Now the challenge is, how do you reduce carbon emissions? Because if you're producing 8% of the carbon and the world is moving towards carbon neutral, how do we go about doing it? Now they break the problem into 2 parts. There is one which is the process part. 50% of the carbon emission in this industry is the process part. The cement is made from clinker. Clinker is made from limestone. Limestone is CaCO3. I'm not a chemistry student, but I learned in the last 1 year when you put limestone in a kiln and burn it 1,500 degrees centigrade, you produce lime and the carbon is emitted. Now, can cement be made without limestone and without clinker? Answer is no. As of now, no. And the balance 50%, if I put it, is more in terms of the fuel which is used to burn in the kiln, right? And so there are two parts of it. One is the process part, and one is your thermal emissions. And if you look at what the cement sector, and especially what we are doing, I think on the thermal emissions part, there's a lot of work which is being done globally and even by the sector and us as a company. I think we have already committed to be almost by 2035 to be 100% biomass, all renewable energy. We're talking about EV 100 by 2030. We are talking about green fuel, and we're scaling it up. We're investing large amounts of capital into WHRS, into solar. And I think with hydrogen and, again, the technology is evolving, but we feel very confident about the 40% that we are speaking about coming down very significantly down, almost zero. But but the process emissions are something which requires a lot of technology innovation. And, they're at the infancy stage, they're expensive. And in a country like India, how easy is it going to be able to reduce the process emission is something we'll have to look at. Yes, we as a company have committed to move to 100% blended, which means that we'll use less and less of clinker as we produce more and more cement. By 2025, we'll be 100% blended cement company. So to that extent, we are doing our bit to reduce the usage of clinker in cement manufacture. But I think a lot of stuff would depend on the technology and the innovation and the regulations and how the finance and the funding evolves around that. So I think huge opportunity. I think I see the cement sector in India growing between 8 to 10% year on year. The larger players have a much larger opportunity. But at the same time, I think being socially conscious and being environmental conscious, I think there's a lot of work which we are doing currently. We produce probably one of the lowest carbon in the world per metric ton of cement. We are at 492. I think global average is about 608 or 610. So you're almost about 20-25% lower than the global footprint. And we, through a lot of measures we are taking, hope to reduce it to about 350 in the next 6 to 8 years. So I think we are on a good footing, but a long way to go.
Okay, thanks, Rajiv. That was super helpful, super insightful. And I must add to that look, I think if I'm not mistaken, for last 2 years you were the only cement company invited at the UN Climate Summit. So we tell all our investors that look, cement, aluminium are part of building blocks. If you're investing in EMs, we cannot deprive hundreds of millions of people in EMs of a good life, of urbanization, which the developed world has done. What we've got to ensure is, as emerging markets urbanize, as masses like India urbanize, which is a huge kind of a potential, we reduce our carbon footprint. And look, people on ground face the challenge. My parents, my family stays in Gurgaon, and we all know about what happens in winter, the smog which covers Delhi or NCR region around the winter months. So it impacts to each one of us. We have our dear ones who get impacted because of this, and we are committed to it. But it won't be fair to throw the baby out with the bathwater. Clearly. Mr. Pai, coming to you on the recycling Novelis is doing, give us more insight on that. Again, I've got a teen boy here, and I keep hearing these words of circular economy from these Gen Z. Just your insights on Novelis recycling. Can we do that at Hindalco level also in India?
So I think that, to give some real specific numbers on recycling so you can understand the impact it has. Today, if you take the largest markets that Novelis participates in, so the biggest market, 60% of their output goes into beverage cans or packaging. And if you take the average recycling in a beverage can in countries like Brazil or Europe, it's over 85%. Actually, the US is the lowest at about 50 to 60% because the US does probably the worst among developing countries in recycling, and we are trying to improve that. So what that means is that every can of aluminum that's produced, more than 85%, and we are trying to take it to 100, is recycled metal. So that is a definition of circular economy in the sense that if you can produce a can and use it constantly by recycling, and the only loss is the metal loss when you actually remelt it, then if you look at it over a 20 or 30-year cycle, you have taken quite a lot of potential carbon emissions out of the equation. Now, if you move from that beverage can and now you get into autos and you get into, buildings where you do doors, windows, and you start to think about applying that same circular economy, that's when now the breakthroughs in technology that Novelis is investing on actually comes in. Because if you now take an automobile that's an electric vehicle or any other aluminum intensive, there the recycled content is only about 20-30%, and most of it is what you call runaround scrap in the building of the car. The end of cycle, which is after the car gets junked and the metal gets recycled, the percentages there are very low. So huge part of the effort now is going into how can you design and build an automobile so that the recycled part of it can come up to 50, 60, 70%. Because then if you can drive an electric vehicle as well as you can get recycling to those levels, then you have really got the circular economy going. So I think the challenge in the aluminum industry that we are working on is to replicate what we did with the packaging industry into the automotive industry, into the building and construction industry, trying to set up those supply chains to segregate, collect the scrap, bring it back into the system. So this is the challenge that Novelis is investing heavily on. I was actually in Seattle meeting a large plane maker over there. And I don't know if you realize that for every 100 kgs of aluminium, ultimately only 10 kgs ends up in a aeroplane. So if you look at the amount of metal that is being lost in the equation, it's huge. And it's a very high-end metallurgy, very high-quality alloys. But this recycling chain needs to be set up to make the circular economy work. So I think that this is the challenge that the world is facing. It requires consumer behavior to be made different. People need to help in the scrap segregation part so that it doesn't get mixed up. And then you need to have a supply chain that collects the scrap, brings it back, and gets into a new product. So I think this is going to be probably the one that has the maximum impact on the environmental and sustainability aspect, Rahul.
Okay. And Mr. Pai, just getting your thoughts on the fact that, look, Hindalco has been one of the few companies in India in the mining sector which have not really seen any big mining accident. There's not been any issue on exploitations. It's been very harmonious in terms of working with the ecosystem it's operated in. So just your thoughts. I must add for the benefit of our viewers that, look, Hindalco has been winner of the National CSR Award in India also. Just your thoughts on how you manage this. Because, look, there are always, in a country like India, there are always local politicians that work. They want to make an issue out of it. For no fault of yours, even a minor incident gets blown out. So those are real practical issues one knows, having grown up in the market. But your thoughts on how you managed to handle it so well over the years?
Yeah, I think that's why the S part of the ESG becomes very critical over there. And I think the Aditya Birla Group, I guess I would not be exaggerating too much to say that over the last 60, 70 years, it has built a deep-rooted credibility in those communities where we operate. So you're absolutely right, a public hearing. In fact, we just did a public hearing for a mine. And, there are 10 people who will support you, and there are, another 2 or 3 who are going to fill the social media about how we are exploiting the villagers. And I guess, but, if you look at it consistently over so many years, we have a very harmonious relationships. And I think the word CSR, we have probably grown beyond what I call CSR, because CSR is quite restrictive in my opinion. I think that, today you have to take another holistic picture about all the communities that are living around, whether it's your factories or your mines. And then you have to build a very comprehensive program of livelihood generation, because the way it used to work in the past is that people would allow you to do a mine or a factory because they would get jobs in the mine or factory. And that is changing because of automation. Today, a modern mine, a modern smelter requires 1/10 of the jobs that you used to do 20, 30 years back. So the livelihood generation now, you cannot just get away with saying, I'll give people jobs in your factory or in your mine. So I think a lot of effort is being put in by us now to make sure that jobs can be created that will last long after the mine has been completed and closed down. So these are some of the programs that we are working with, and I think we're getting good traction with the communities that live around us. We were the first company in India to come up with a sustainable mining charter, which talks about a new land policy where the land is not taken from the farmers, but actually is leased for 20 years and given back to them in the same condition. So if you take our biggest bauxite mine, Baprimalli, where Utkal runs, we have now got a fairly unique project where it's a mine backfilling. So the bauxite residue, after treatment, is being put back in the same mine, the covering done, the forestation done. So you are actually, increasing the forest cover and getting the land back to where it was before. So I think these are some of the initiatives that we are doing that allows us to get that social harmony. Because coming in our business, I'll tell you, the biggest thing we have is society has to accept the need for companies like Hindalco to mine bauxite and produce aluminium. And to get that societal acceptance, you will have to go, in my opinion, far beyond CSR and try to really work with all the people and present what you're doing so that they are very clear that, things are being done in the right way. Because I think today that's the biggest challenge that most companies will have. If you want to open a new mine or a new factory in India, you may get all the sort of clearances and the money, but to get the people around that area and the societal acceptance is a huge challenge.
No, I think that's clearly insightful. Again, I've been tracking India for now about 22 years, and it's amazing how you learn new thing every day. Rajiv, coming to you here, and this is more from, we all are senior members of teams in our respective organizations, and it's very important for us to take our team members along, to get the buy-ins from our bosses for doing what we think is right, and from our juniors or subordinates who will actually execute this. So walk us through this, and for you, there was an added challenge when you came at Dalmia Bharat, that you were an outsider. So just walk us through this journey. How did you manage buying? I jokingly tell everybody that handling people is the toughest thing. And smart people, obviously, you got to keep them happy. You've got to keep them challenged. Just walk us through that part of the journey.
It's very, very interesting that you say, handling people is definitely the most challenging part, because the emotions involved, their perspectives, and, thing is, you just have to be more smarter. I guess, when you're dealing with smart people, you have to be a little more smarter, a little bit extra, which is required to be able to convince them. But, jokes apart, I think it's a belief in something. When you believe in something and you're convinced about something, and you talk about with conviction, and you can show the light at the end of the tunnel. Every transformation, every change journey is difficult, right? There's always going to be naysayers. There are always going to be people who are going to say, look, who are waiting at the edges and saying, oh, look, I told you it won't work, and why did you even try, right? So there are always going to be those kind of people. But I think if you believe in something and you're absolutely convinced about it, I think the rest of the journey is pretty easy. And when I joined the company, thanks to all my friends in the investing world, I had an idea about what I'm getting into, what my journey is going to be, how easy or difficult it's going to be. But at the same time, I think there was a sense of purpose, in the sense that, as one of my friends in one of the large funds in US told me, he said, Rajiv, this can be a case study in India. There's so many family-run businesses in India which reach up to a certain point in time, and after that, they somewhere lose the plot, right? And if you can help cross that hurdle for one of the companies here, it could become a case study. And I think before I started, I did have almost about if I'm not mistaken, I think 14 1-hour conversation with Puneet in terms of the journey ahead, what we need to do, how we're going to set about doing this. And first, I think 50% battle was won once I had the buy-in from Puneet and the promoter family. I think that was the biggest. And after that, what I've seen is everybody wants to do things right. Everybody wants to work in an environment where they feel they're recognized. They can add value. They like working transparent organizations. So I think it was not that difficult. Yes, initially there were hurdles. It was not initially. It was getting a buy-in from a lot of people, as you rightly said. Every organization, there are people who have been in the organization for years. They have their eyes and ears to military. So, but I think once you believe in the goal and the story and the output, I think it was okay. So initially not easy, but I think now we have kind of probably done 40 to 50% of what we had set out for. Still a long way to go.
Okay. Thanks. That's very helpful. And just probably starting with you on a follow-up question, which is Prime Minister Modi surprised everybody when at COP26 he said that look, India would be carbon neutral by 2070, and then talking about the fact that we'll increase renewables as a share of energy mix by nearly 30% by 2030. So any thoughts over there? How are we looking? Rajiv, first from you, and then probably from Mr. Pai.
No, I think that is a very bold statement from Mr. Modi, and clearly we are the developing nation. We still have a long way to go. Urbanization is a big theme in India. I think there are aspirational people. We have a very large, younger population, very large middle class, and this young population has very, very high aspirations, very confident. I think today's youth is far more confident than I've ever seen. I've been working for the last 26, 27 years, but when you deal with the freshers and the youngsters, I wish I was that confident when I was their age. So they're very, they're very confident about the future. And I think a lot of it is also to do with the kind of environment we are in, right? In fact, I was reading a survey where the Indian youth is probably more confident than the youth in the Western world today. So, there's huge opportunity. And I think from Prime Minister Modi, not to buckle under the pressure and say, look, India needs to take time. They have to develop. They have to build infrastructure. They have to do things right for the large population. At the same time, we committed to this environmental thing, because this is something that we can't live in isolation. Being a part of a larger global community, we have to commit to. So I think he balanced it out in a very big way. It also gives us some room for doing things in a timely manner, because the fact is, as I was saying, cement is the most widely used man-made material in the world. And the Western world, if you look at most of the infrastructure, almost everything in the Western world, China has been built. And cement, you can't build this without cement, right? Now, if tomorrow it comes saying that, look, cement industry has to become carbon negative by 2040, it is just not possible because no technology. As I said, 50% of the carbon emissions are because of process issues. When you burn limestone, carbon is going to get emitted. Now, because it is such a cheap commodity, there's not been much of innovation in this field, because every innovation requires a huge cost to be incurred upfront. You are not sure of the returns. You don't know the payback period. And you really it is such a low value and a high volume commodity that people are willing. So I think it requires a lot of push. And I think I feel very good about what Prime Minister Modi took and committed on behalf of the country. He actually, we have a 50-year roadmap. And I think 50 years is a long time. We can build, we can develop. At the same time, we can actually deliver on the promises he has made. So as a sector, as a company, I think we feel very excited about it. Definitely all of us would try to do things much faster and have committed to do things much faster. But I think as a nation, if I wear a hat of a citizen first, I think I feel very excited about what he has said and the commitments he has made. And I think that's the right thing to do.
Mr. Pai, your thoughts on this, Prime Minister Modi's commitment and then increasing share of renewables. And then we'll also talk about a slightly controversial topic, which is the green aluminum, but I'll keep that for later.
Yeah, I think that, look, a company like Hindalco has already made the commitment of net zero carbon by 2050. So I think that, there are some real practical issues we need to look at. And I think that probably what he also said, which I think needs to be as much repeated again, is that the Western developed countries have a moral obligation to help in this transition that developing countries need to go through. And in my opinion, that help, I'm not so as much worried as the money part, which gets talked about, but it's the technology part. Because I think that for big economies, especially developing economies like India and China, you're not going to get to a net carbon unless some of the technology breakthroughs that are being worked on actually happen. So for me, the most important part is that if we talked about 500 gigs of solar and wind, right? He said India is going to commit to get that much of renewable. The problem I have is how will the grid in India handle that much renewable without a proper storage technology? The base load that is required for industry in India will not be able to run with that amount of renewables unless there is a proper storage technology that's there. I think that, for India, the best way to transition to a low carbon is to dramatically increase the amount of natural gas that is used in industry. The government is actually working very hard. A lot of pipelines, especially in our Odisha belt, where most of the steel and aluminium companies are, the gas pipeline will be ready by this December. So, you can dramatically cut from coal by using natural gas. Let's take aluminium, 20 tons of CO2 per ton of aluminium or 18 for coal can come down to 6 straight with natural gas. It's not zero yet, but you get a dramatic reduction if you can start to use natural gas. And I think that the other part that is important for a country like India, for the base load, is that we have to do like what China and France has done, is to get at least 20-25% from nuclear. Again, there, the society and the social acceptance of nuclear because of past accidents has not been there. But then again, technology has evolved quite a lot. So I think the government has to sell the new nuclear technology that's coming out as well. And I think that a proper energy plan needs to be made for the country. I think it's too simplistic to say we're going to put 500 gigs of solar and wind and the rest will continue with coal. I don't think that will get us there. You have to bring the amount of natural gas and nuclear into the mix. And talking as an aluminium producer, energy is the one that, we like to say that Hindalco is actually a power company and we also make aluminium.
Yeah, no, that's interesting. And then that gets us to this question where we have the global majors who generate significant quantities of their aluminium from hydropower, taking this as an opportunity to say that, look, for developed markets, we should have green aluminium. And in 5 years from now, there is talk of all this carbon tax being introduced. So somewhere, look, everybody cares for climate. Everybody wants to reduce the pollution. But some of these interests come through. So how does one navigate these that look so that all corporates everywhere work towards a common cause?
I think that, look, it is quite natural that everybody who has any advantage is going to propagate their advantage. But I think it's the consumers and investing companies like you, Rahul, will have to make that differentiation. So you have a company X that has been using hydropower since the 1960s. And today says that, oh, I am green because, I had that hydropower since 1960. Have you really reduced any carbon that was being emitted? No. Can you expand your aluminium production to meet the needs of the developing countries using that hydropower that you have since 1960s? The answer is no. None of those companies have got any expansion plans of aluminium because hydropower, Rahul, is not green anymore. If you want to put a new hydropower project in India or anywhere, the society and the NGOs will be the first one to stop you. So I think that trying to take a historical power source and saying that you're green, in some ways is defeating the whole purpose of helping people to transition to a greener energy source. And to take into account, I think as Rajiv was saying, if the world is, you're going to need more cement, you're going to need more steel, you're going to need more aluminium. So how are you going to get that capacity expansion to happen with a power source that has got low carbon? I think that's the challenge. So putting taxes, trying to split up companies, which is, and I don't know how investors accept that. So a company X takes its coal assets and puts it in a separate company, and suddenly the mother company becomes green and very attractive to investors. So I struggle to see how the world in general is benefiting from these sort of games being played, whereas we are missing the point that there is still growth to happen. There is still materials that need to be physically produced so that people can develop and poverty can be alleviated. And it has to happen. So I think the energy should be spent more in technology development, putting proper new energy sources, more natural gas in the mix, rather than trying to do things like carbon tax or trying to say that aluminium produced with hydropower should get a premium.
No, I think that's absolutely well said. And I think the key thing is that we've got to discuss these core issues rather than just find comfort in somebody who's carbon neutral and make our portfolios towards that. So this is a discussion we have internally that, look, should we have carbon neutral portfolios, which some of our peers are saying that they'll do by 2030. If you're investing in EMs and where you are kind of playing this theme of large part of EMs going for high urbanization, that's just not possible, because then you'll be depriving support for a significant part of the population which wants and demands a better life. So absolutely would agree with you here, Mr. Pai. Rajiv, I'm just mindful of time. We've got last 4-5 minutes, and I would like to get inputs from you on how Dalmia Bharat's worked with the communities at large during the COVID times. We've seen COVID's hit India particularly badly. The tier 2, tier 3 cities, the semi-urban rural India has been impacted. So what is the work we've done with the communities to heal them basically in this time?
So we do a lot of work. We have a very robust CSR program. We have a Dalmia Bharat Foundation. And what we also do is, in addition to the CSR contribution that we do, we also raise private money and public money to increase the portfolio so that we can touch upon many more people's lives. We operate in 14 different states, and clearly COVID did catch everybody by surprise. I think we all have seen news reports where people were kind of going back from cities to villages, by road, and it was kind of something which hopefully, and I really hope doesn't happen in anybody's lifetime again. But we as a company came forward. I think we work with every stakeholder, whether it is start from employees, families, working with the workers, their families, the communities at large that we support, working with the government, the hospital. So I think we actually had a crack team under HR and an admin department who was working 24/7 with every stakeholder, whether it is the hospitals, whether it is the government at large, whether it is, NGOs. And I think we touch wood, yes, we did have certain, casualties and certain mortality rates, but, I think we were able to a large extent, be able to take care of the anxiety of people. Clearly we couldn't have done much in terms, we ensure that they got proper health care at the right time. But I think it was also very distressing for them in terms of the financial needs, in terms of the emotional stress that they went through. So I think a large part of our program was also focusing on how can we take care of families where the challenges happen. If somebody's hospitalized, how can we take care of the families and larger families, and how can we support them? So we actually ran a program across multiple functions. We have still not opened up our offices. We are still very cognizant about the fact that we don't want to take any chances. We employee health and it comes first. And I've been here for about a year, and I would say that as a company, I feel very proud of being a part of a company which is taking care of its employees and the largest stakeholders in these tough times. So again, we can go into details of how we worked in each of the villages in terms of how we created camps, how did we actually also in Dalmia Bharat we just gave it sanitizers, we distributed kits. So we've done a lot of work in terms of the lowest strata of society of how we can touch them in addition to the other stakeholders. So.
No, I think that's really heartening to hear. Mr. Pai, your thoughts on this, how Hindalco has worked with the communities at large in India, what's Novelis done globally in this COVID times where our employees have got hit, their families have got hit. So it's taken a huge emotional toll, and yet we expect people to come to work every day and give more than 100%. So just your thoughts on same.
I think that your last bit was, we expect people to give 100%. You have to realize that work from home is a luxury that only corporate types have. My plants don't have that luxury of working from home. So all our smelters, refineries, whether it's Novelis, they ran completely through this whole thing. And I think that that's why I always point out that the last 2 years, what we have to recognize is the amazing effort put in by all the factory workers who have kept all these plants running. And I think that, what lessons? We did a lot of things, which I think, it's, but let me probably tell you what is the issue that I have noticed that we as a country really need to deal with. It's the medical infrastructure. I think that, the state of the hospitals and the state of the medical infrastructure really got exposed during this whole thing. So the little that I could do, which is the Hindalco hospitals in Western Odisha, Renukut and all that, we have got them completely built up with CT scan machines, piped oxygen, so that we can be ready if this thing ever happens again. But majority of our trauma, which I think what Rajiv was saying, was not with our employees. It was with their families that were living in different cities. And the whole Hindalco network was set up to support families that were, in different towns in India and were actually struggling to get that medical help. And I really don't know whether we are really ready for any other wave, because people have now started to sort of think that this is over. But my worry is that the medical infrastructure in the country is really the one that is fairly weak. I joke very often that we probably have more school engineering and MBA colleges, but I think we need all these people to invest in more hospitals, because I think that is the part that got most exposed in this whole last 18 months, is the lack of the medical infrastructure.
No, absolutely. And while you were saying, both of you were saying this, I was just reflecting on all these things. It's amazing. In fact, one of our investors told us that when I told them about the work we've been doing with the companies and all the CSR activities our company's been doing, particularly in India for the last 20 years, his kind of a feedback or advice to me was, Rahul, we know that you all are doing so much, but again, a very important part of ESG also is showcasing your efforts. For people to know that this is being done. So it would be nice from both of you that if we see this in coming annual reports, in coming ESG disclosures, all these efforts, all these stories from the communities, that how are we shaping our communities? Like I tell all our investee companies that in today's world of 24/7 scrutiny because of this digital media, our good and the bad gets amplified. So we've got to be watchful of what we do, because it's a constant scrutiny. But I'm so glad that we had somebody from Old Economy today. The discussion won't have been so fun, so insightful had we had people from whatever fintechs or these tech platforms which everybody runs after. Thank you, Rajiv. Thank you, Mr. Pai, for joining. I think it's been very, very helpful. And I think this is the way forward. You guys are the building blocks of any economy, and cement, aluminum are the key things for any economy. And it's important that you work to reduce the carbon footprint. And of course, carbon, as Mr. Pai corrected me, is just one part of the story. Then there is social governance, and that's how we achieve a holistic balance.
Thank you, Rahul. I think it's a pleasure to be here and share our thoughts. And I think it's a long journey ahead, but I think we are committed and we're very confident about meeting the targets that everybody has set out for. Thank you.
Thank you.
Rahul and Rajiv and Satish, thank you very much for that excellent discussion. We're now going to move on to the last session, and I'd like to welcome our final speaker, to the screen, which is Holly So, who will be joining Rahul to discuss Mirae Asset's commitment to ESG. Holly joined Mirae Asset Global Investments in Hong Kong as an ESG specialist, spearheading our ESG initiatives of the firm. Holly oversees the ESG integration process and stewardship activities, including proxy voting and corporate engagements, and also manages our ESG-related content and production. Prior to joining Mirae Asset, Holly worked at PricewaterhouseCoopers in the climate and sustainability team. During this session, Holly and Rahul will discuss three main areas: Mirae Asset's approach to ESG investing, why is ESG important to Mirae Asset, and finally, how is Mirae Asset dealing with the recent regulation around ESG fund labeling? Rahul, if I could ask you to come on. Hi, Holly.
Hello, thank you, Nick, and happy to be here. And thank you very much, everyone, for staying online. And we've had some insightful sharing from ESG professionals on the ESG investing trends, as well as some insightful discussions with corporates on how they're tackling ESG. So I think in this session, it'll be back to us for Mirae Asset to share our ESG processes. So Rahul, maybe let's just start with the when and the why. When did Mirae Asset start on this ESG journey, and why? What's our philosophy around ESG investing?
Okay, so Holly, this journey started way before ESG was popular. We were signatories to UNPERA in 2015. That was much ahead. Most people, if I see, did it in last 3 years. And again, within a year, we had our internal ESG scorecards. What we realized was when we looked at, again, the ESG kind of data providers like MSCI, etc., we saw that there were two issues with that data. A, that data coverage was largely confined towards large cap companies. Obviously, they didn't have the bandwidth to cover small mid cap companies in details. There were commercial interests involved over there. And secondly, what was happened was because there were a few analysts kind of updating the data updation was not regular. In best case was an annual thing. So which is where our point was that, look, let's do it internally. And more importantly, our approach which we took was that, look, each one of us has to believe in ESG. Each one of us has to engage with our companies. And that's the true meaning of kind of an ESG, rather than follow which I see some of our established peers doing, having large teams of ESG specialists, and then those teams creating a short list or pool of stocks you want to invest in. Our approach has been that, look, from a money management perspective, we want the most competitive business models. We want managements who are the category disruptors, who are the thought leaders. And then we look at business parameters. ESG for us is like a business ROE. So you buy businesses where ROE improves, not businesses where ROE falls in future. Similarly, when you look at ESG, you look at companies where you believe ESG parameters will improve. And we are willing to work hard. We are willing to take the tough task, which is spend a lot of time with the companies, handhold them, and spend time with multiple levels in a company to ensure that they achieve high standards of ESG. And Dalmia Bharat is a great example. I mean, I personally would have spent more than 15 to 20 hours with different people in the company. Again, Rajiv was one of them, but Puneet, who is the founder over there, we did multiple sessions on what is required of that company, which was very good in terms of execution, but governance was lacking. A number of other things on carbon footprint was lacking to become best in class.
That sounds great. Now, I think especially asset managers in Asia, being a UNPRI signatory since 2015 is definitely proving that we were one of the early adopters, and especially, as you said, having a proprietary ESG scorecard since 2015 as well. So could I ask you to share a bit more about the scorecard, how it's evolved since 2015, and any updates we've made to date now, and who goes about doing the ESG scorecards? Is it the analysts? And, what's the process around making sure that ESG scorecards are done?
Okay, so something which I'm very proud of is our ESG scorecards. Look, initially it was just a standard scorecard. It was a good scorecard, but it was a standard scorecard. What it lacked was customization, and what we've done over the last 12 months is because of the efforts with our team members. We made it a customized scorecard. So the process of kind of a formation of this customized or bespoke scorecards, where we've done 24 industry groups, was having the ESG specialists, having the relevant analysts, and I as CIO and somebody overseeing the ESG initiatives at Mirae Asset Hong Kong. We were all together. We were looking at each of the parameters, how much a particular parameter was relevant to our industry, and then weighing it separately. So look, again, that's really the way to approach things. Look, environment is more relevant for heavy industries than others. And similarly, if you look at social, is more relevant for the tech companies which employ all these highly talented people. So I think building a bit of nuance to it. And as I see the scorecards after the team's done it, they are wonderful. The amount of data we are picking at, it's just phenomenal. I think the challenge to that scorecard is that now we've got to push our companies, whether it's investee companies or companies which are under our active consideration for purchase, to disclose more data. So what I see is, as I go through the scorecard reviews, and I've been reading all these scorecards in recent days, is that we need more granular data. We need to challenge our analysts a bit more. So I think that's the agenda for us for 2022. But what we've achieved is phenomenal.
No, thank you for that sharing. Our ESG scorecards are definitely a core part of how we do ESG integration, because it's the major tool of how it's incorporated in our fundamental research. But then what about exclusions? So negative screening. What's our view on that? And what's our journey been on having restrictions on our investments?
So initially we started with the standard exclusions. Tobacco was there, adult entertainment was there, nuclear weapons was there. And look, as the transition happens more towards Article 8 funds, these exclusions will get a lot more wider, broader, etc. So as we kind of discuss, this exclusions would kind of include your unconventional oil, which is shale, etc. Coal mining is what you don't see in portfolios. But I would say these exclusions are a small part of the portfolio. The bulk of the effort, I as the CIO of the team and one of the key members who engages and meets nearly 200 companies a year, would have is working with the companies to reduce their carbon footprint. So it is constantly challenging them on their processes, constantly kind of nudging them, pushing them that, look, how can we improve our processes? How can we reduce our carbon footprints, etc. and all these. And there are sectors which are kind of harmful, and we would over the years kind of widen these exclusions.
It's great to hear that thermal coal mining is something that we don't invest in, especially with the firm focus that it's been discussed from COP26. The phase down of coal, as well as fossil fuel subsidies. So I think it's in line with where the global market is going. But then what about sectors like conventional oil and gas and utilities? These might be a bit long term. And what are our views on these, and how do we think about these investments when it comes to portfolio composition?
So we've taken a two-pronged approach. A is we're going to be in top quartile companies in these sectors. But more importantly, a key important factor of that approach is that, do we see a transition to clean energy plays in next 5 years for these companies? So to give you an example, Reliance Industries are traditionally fossil fuel companies in our portfolio. But if you see, the company started making this transition into a consumer-facing company in the last 20 years. So they've got a very good retail portfolio. They've got a very good telecom portfolio, which is going to be hyped up. But more importantly, in the core business also, Reliance is very clear that they're going to move to renewable energy mix. So you will see a lot of these things kind of come and play out. So the idea here is, look, be in top quality kind of companies in terms of the ESG scores, etc. in these sectors. But more importantly, make sure the companies we are invested in have a clear path towards decarbonization, towards renewable energy mix in next 5 to 7 years. See, economies need energy, and it's these companies who know how the business, how the sector runs, who are going to be at the forefront of it. We've got to be supportive of companies which are driving this change.
We definitely have a couple of ESG strategies going on, having ESG integration with our ESG scorecards, and some sectors we include in our ESG restrictive list. So we do some negative screening. For those for those sectors that we think are harmful but might take a longer term transition. We have our own approach and engagement with companies to ensure that we pick the best ones. But then how do we monitor all of this? Is it on a monthly or annual basis? Who takes the responsibility of monitoring this, making sure that we comply with all the requirements that we've set out?
Okay, so I think like the way we kind of discussed, we've got our investment team who's got ESG and all these criteria is pretty much like a ROE at the back of their mind when they're recommending companies. But look, what we've seen is the good thing about investment professionals is they're very passionate about the businesses they recommend or they'd like to invest in. But look, that's where a little flaw also comes, that sometimes we fall in love with the company and sometimes we overlook the minor issues with the company. And these may be the ESG issues. So to challenge our analysts and the PMs also, what we have is independent inputs for our research team, for a risk team on ESG ratings. And these are independent raters like MSCI ESG ratings. So what would happen is when the analysts do the quarterly review sessions with the whole investment team for their sector, the risk team would come and challenge them. Again, if they've recommended poor ESG rated stocks, and then clearly as senior managers, one would come and ask them that, look, what is the remediation these companies are doing? As a part of analyst appraisal, we would be one of the few asset managers who put that as a part of their actual performance appraisal, the engagements they do with the companies in the recommendation list. As for our investment team, in fact, initially we got a bit of a pushback, but now, like it happens, everybody's got used to it. We've had 4 hours of ESG training being put mandatory. In fact, that's what the team's kind of working towards and finishing for this year. But all those initiatives are happening. So all those initiatives are happening that, look, your team is on top in terms of evaluating the businesses for the ESG rating. At the same time, you have an independent risk team, which is there to challenge, like the way I mentioned, our analysts in their review sessions. And more importantly, when we do the monthly risk meetings for the portfolio managers, people who are managing funds in our team, as a part of the monthly risk meetings, again, there are firm-wide sessions where the risk team highlights exposure the firm has, Maggie Hong Kong has, to poor ESG kind of scored stocks. They recommend for, or I would say, they highlight for an individual PM if they have exposure to some of these sector stocks where the ESG ratings are below par. And then that's where the investment committee comes and challenges them that, look, give us the reason why you're holding on to these stocks and give us a clear path of how these companies are remedifying these ESG issues.
Agreed. Thank you. I think it's definitely a very robust process that we got, having monthly meetings to go through the ESG scores and this negative screening that we just spoke about. And having that internal audit from our risk team is very important as well, to give us the comfort and the guarantee and reassurance that our ESG processes are in place and compliant to our own requirements. So perhaps we could move on now to stewardship. So we've spoken about investment process. So on stewardship, how do we go about being responsible stewards of our clients' assets? What are our approaches to proxy voting? And you've mentioned a little bit about corporate engagement already, but what are your thoughts on stewardship from Mirae's Assets end?
No, absolutely. This is important to us, and this is something we've been doing for last 20 years. As investors, we were kind of one of the most vocal investors in meetings. Sometimes the management used to not like us, but look, that is our job, to tell management what is right. And in the past, most of the managements followed that, and there are plenty of examples. There's an example of a leading private sector bank where we guys, along with other shareholders, had interacted with them and said that, look, we need a change in top management for certain issues, etc. And that happened. But look, there are cases here and there where managements may say that, look, we'll do the right things, but never follow up. So in the past, we've kind of voted with our feet. We've divested names, and these were very competitive business. So these were, again, businesses which were leading infrastructure plays. These were businesses which were leading healthcare plays. And I must say the top 2 companies and very attractive on valuations. And we knew that we were leaving a lot on the table in terms of stock return upside when we divested, but we didn't get enough conviction from the managements that, look, they're going to walk the talk, and we divested. So again, to your point, this was an actual action we did. On the voting stewardship front, obviously, we've got proxy advisors who feed into the team. We've got an investment committee which looks at the merit of each of these advices, etc., and then decides whether to vote in favor or against that. And in due course, we're going to be sharing all the kind of votes we've done, where have we voted against, and why we voted against, etc. So all those things have been put in place in recent years to make it very streamlined process.
Yeah, it sounds like we definitely have a lot of effort into our investment process as well as stewardship activities. So what are our plans with ESG going forward then?
So this is interesting, and this is interesting because, look, as I asked Rajiv in a previous panel, I think the biggest challenge was getting the buy-ins from our people. And look, like it happens in every team, there are early adopters. There are people who wait at sidelines and see where the team is going, and then they join. And this is others. So I think that's what we saw, and that's where again we started on this journey over the last 4 or 5 years. And what we've seen is in the last 12-18 months, a significant buy-in from the team, and that's given us the confidence to take our funds, to take our ESG kind of processes to a different level. And that different level is Article 8. So I'm very happy to say that give us a couple of weeks and we'll have our flagship Asia product, which is going to be labeled as Article 8 Sustainable Fund. We've got India funds, and we're going to be one of the first India fund to be labeled Article 8 in 3 to 4 weeks from now. We've got an AP fund which is converting into Article 8. And what was more heartening was that after this round of conversion, when I asked my team members that, guys, are you game for Article 8, or would you guys want your funds to be Article 8? I was surprised by the overwhelming response I got. Honestly, Ollie, I thought initially that, look, people would be kind of dismissive of this. People would say, look, there is so much burden, it restricts me. But look, I was taken aback in a very positive way by this whole team looking to move towards Article 8. So I think that is really the real success we've achieved with ESG, the tremendous buy-in we've got it from our team, and that's important. And you clearly realize that there are things you cannot force people to do. Look, we can have an army of 15, 20 ESG specialists, but that does no good if our investment team doesn't have a buy-in on ESG. And I'm very proud to say that, look, our 15-member team has a strong buy-in on ESG. And it's these investment team members who interact with corporates, and it's the corporates who respect the investment team members. So if they see them fully on board with ESG, talking the language, it's very easy for corporates also to learn from them, to embrace the good things. And then that gets reflected in subsequent practices of that company.
No, I definitely agree with you. I think it's very exciting for us to be rolling out ESG products according to the SFDR's Article 8. I think it's very leading behavior from us. And I definitely also agree with you that ESG is something that's really fully integrated in Mirae Asset, because it's a job, a task that is done by our investment analysts. And I think this is a definite differentiator from our side on how ESG is really fully integrated. So I think, cautious of time, I might just pause here and see if we have any questions from the audience. So I'll hand it back to Nick to finish off this session with some Q&As.
Rahul and Holly, thank you very much for your comments. Like Holly mentioned, we have set aside a little bit of time at the end of the session to take questions from the audience. Can I just remind you that there is a box on screen, so you please do send through any questions you may have for Holly and for Rahul. Rahul, we have had some questions come through while you've been talking through your sessions. If I could just go through one or two of these with you. The first question says, could you give an example of an investment decision when a company has not met your ESG expectations?
Okay, Rick, it would be hard to give a name here, but I can give some kind of an idea about that. So they've been companies, and kind of I alluded to that in my discussions with Holly. These companies were leading players in the healthcare space in the Asia Pacific region. These companies were leading infrastructure assets owner in the region. And look, we worked with these companies for about 2 to 3 years. We gave them enough time, and these companies always talked all the right things or ticked all the right boxes in terms of speak on ESG. But when we looked at practice, the practice was absolutely miserable. So then we realized that, look, again, this is a time where we've got to bite the bullet and exit our investment. So we did that at a loss to the purchase, about a 10% here and there, not a significant loss. But we left, when we sold, we knew we were leaving a lot on the table. Those stocks are up 50-75% from those levels where we sold, but we are happy about the decision. Yeah, look, you can sleep peacefully, and then we know these are our priorities, and that's how we work.
Rahul, thank you. Okay, the next questions come through, and I'll just read it to you. What do you do when a company has no ESG disclosures from an investment perspective?
Okay, so again, this is something we are facing with some of the A-share companies, where I won't say it's a complete no on entire disclosures, but some of the parameters are missing. So this is something, there was an internal discussion beginning of the year, that do we penalize these companies or we give them grace 12 to 18 months? And that's where we've gone ahead and told our analysts that, look, these are your recommended stocks, so you better work with them so that the disclosures are up to mark in next 12 to 18 months, else we'll penalize these companies. So we must understand that when a company goes IPO, you've got to give it some time, 12 to 18 months. A similar thing is with A-shares. In the past, the thought process in A-shares was that, look, the local investors wanted companies to focus only on business, on growth, on deepening the moat, and thought ESG was a waste of time. I think that view is changing in last 12, 18 months. And that's where our investment professionals, along with their peers, are working with these companies to improve disclosures.
If I could just add a little bit on this question as well. I think two things. Firstly, a lot of the listing exchanges around Asia have really introduced more ESG reporting requirements, either introduced new ones or have updated or kind of ask for more stringent ESG reporting requirements. So I think from our side, at least in the next 1 to 2 years, we'd hope that with these more stringent compliance requirements around ESG reporting, we'd see kind of enhanced ESG disclosures from corporates. And I think second of all is in our ESG scorecard, we, other than just relying on corporate data, we also look at some alternative data. So we might look at news articles or, NGO reports about these companies. So relying on alternative data, news and controversies around these companies gives us more of an objective view on how that company is doing around ESG issues. So just wanted to add a few notes there.
Holly, thank you. And in terms of third parties, questions come through. What do we do when a third party ESG rating agency gives a different ESG score for a company that we may be looking to either invest in or maybe one we hold?
I'm so glad, Nick, you asked that question. That was at the back of my mind, and somewhere I didn't kind of talk about that, but very happy because Dalmia, Bharat, the company which has been invited to the UN Climate Summit twice as the only cement company. If you look at MSCI ESG data, their carbon footprint would be the worst or the highest amongst their peer group. So again, it was a shock for me when I look at company disclosures and when I look at an independent ESG rating. So obviously, that's where if you work on only the outside ratings, you'll make the mistake. So what you do is, you work with the company and tell them that, look, they've got to reach out. Practicing is one thing, but disclosing and making sure the records are updated with independent raters is equally important. And B, you reach out to MSCI and tell them that, hey, this is the company annual report. This is what they're showing, and your data is not updated. See, what we've got to also understand is the external rating agencies have their constraints on the headcounts, etc., and the sheer breadth of stocks they can cover. So very often what happens is, and this happens more with mid caps, small caps, the data is a bit old and is not really been updated in recent times.
Rahul, thank you. Another question's come through, and we're going to sort of come back onto the subject of ESG scorecard, which I know you're quite passionate about, Rahul. The question is, can you give some more information on the structure of the scorecard in terms of the granularity? What are the weightings between E, S, and G, and what are the key factors that you look at and consider?
should I take this one, Rahul, and you can add any bits after my reply if I've missed anything. So our ESG scorecard is sector specific. So Rahul mentioned earlier that it covers 24 industry groups. So when we designed this ESG scorecard, we looked at a range of sources. So these include ESG reporting frameworks like SASB and GRI, as well as the methodologies behind some of the third-party ratings like MSCI. So we did an internal exercise around this, had back and forth discussions with our analysts and PMs as well, to discuss what topics are really material for each of the sectors. So after this discussion for each of those 24 industry groups, we have selected a range of E and S topics. Governance, which includes corporate governance and business ethics, would apply to all sectors because governance is applied to all, whereas environmental and social, we picked material topics. So that was our first step. And then second step is we applied weightings. So weighted scoring for each of these industry groups as well, across E, S, and G. So for example, semiconductors, because you need a lot of water in semiconductor companies, you need pure water for cleaning purposes. So for these sorts of sectors, we, for example, would apply 50% weighting for semiconductors. Another example would be, software and services IT companies. For them, social would be a more important issue because you'd need some diverse kind of technology specialists, and there are cybersecurity and privacy issues when it comes to operating in the IT industry. So for those, we might have applied a 40 to 50% weighting to the social pillar. So these are some of the examples. So some of the key topics within environment would have would have emissions, waste management, climate change. These are some of the examples of environmental topics. For social, some of the topics under this pillar would include human capital management, health and safety, social supply chain management. These are some of the examples of our ESG scorecard.
No, thanks, Holly, for that. Just to add to that, Nick, my job was to come at the end when these guys had their parameters to come and challenge each of the analysts on the weights. See, very often what happens is, as a human, look, you would put a higher weight for parameters you think your industries, your sectors would do well in. So there the point was, look, we're going to have at least a minimum weight on each of these parameters. So we cannot go below 25% for these parameters. And then you discuss that, look, do we really need to put a 40% for this? Do we really need to put a 30%? Why do we do this? What is happening? What are the core issues? And the idea here is not to shy away from contentious issues. I keep coming back to it. Look, there are always two approaches to a problem. We can run away from a problem and hide in something good, or we tackle the problem head on and try to solve this. So that's an approach we've taken as a firm. When we talk about emphasizing on our engagement, that is the whole approach we've taken, that we'll take the hard way where we'll work with our companies and make sure that they improve on their ESGs, and whether it's governance, whether it's the social impact they're having, whether it's the environment or the carbon footprint. That is an approach, and that's something you'll see each of our team members kind of embracing and showcasing.
Rahul and Holly, thank you for that. One final question that I have from the audience. How are you monitoring your financed emissions? Do you have plans to set carbon reduction targets or net zero targets? And that's a question for the two of you.
Okay, so I'll answer that. Look, as a part of the monthly risk meetings, what we've also started highlighting is, particularly for the funds which are going to go Article 8, is the carbon footprint of the portfolios. So we have the carbon footprint of the portfolios, and I'm very proud to say that, look, the funds I mentioned, whether it's an India fund where the carbon footprint is 30% lower than the benchmark, the Asia and the AP fund, again, the carbon footprints are 20-30% lower than the benchmarks we have. Our ESG scores are higher than the benchmarks. So in the monthly risk meeting, the risk team, when they highlight the liquidity risk, when they highlight the detractors, contributors to the fund, also highlight the ESG rating of the funds. They also highlight the carbon footprint versus the benchmark of the portfolio. And the thought process is that in coming years, by engaging with our companies and working with our companies, we look to reduce the carbon footprint of that portfolio. So that's one part of the story. The second part of the story is having a net zero as a firm by 2030. And now that's a complicated subject. And why I say that as a complicated subject is something we discussed in our earlier panel also. When you're investing in EMs, where markets like India, Indonesia, parts of ASEAN would have only 30% urbanization, and you don't have a good technology to make an industry such as cement carbon neutral by 2030, somewhere you're depriving these people a chance to grow to a better life. So I think we would rather take an approach of working with the companies and reducing carbon footprint by at least mid to high single digit every year, then come out with these targets of having a carbon neutral or a carbon zero portfolio by 2030. That's easy to achieve. See, if you invest in multinational consumer companies, if you invest in tech platforms, if you invest in financial companies, you can do that. But look, I don't think that would be truly impact investing. That would be truly bringing about the change our investors have entrusted us with, basically.
Rahul, thank you. We actually have no further questions from the audience. So Rahul and Holly, that does actually conclude your session. So I'd like to thank you both for your valuable insights and your contribution today. And it also means that it is actually the end of the ESG Summit. So I'd like to thank everybody who has set aside some time in their schedule to join us today. For our guest speakers, Kasia, Tim, Satish and Rajiv, I'd also like to thank you all for your valuable contribution and for taking time out of your busy schedules. I'd also like to once again thank the Mirae home team, Mr. Rhee, Rahul and Holly, for their participation in our inaugural ESG Summit. So we hope you've enjoyed it. If anybody has any follow-up questions, just remind you, please do send through an email to your local Mirae sales representative. We'll be happy to come back to you with a written response to any questions you might have. ESG does remain a key consideration for Mirae across our business, and we do look forward to working with our clients, our industry peers, in order to ensure that we are fully embracing and integrating ESG within Mirae Asset's global investment portfolios. So please do stay safe and have a great day. And thank you once again for taking the time to join us on the Mirae ESG Summit. Thank you.